The idea of an interest-free monetary system, devoid of exploitative lending practices, is a flawed delusion undermined by human avarice and the inherent dynamics of financial structures. Human greed drives individuals to accumulate and hoard money, whether coin, paper, or digital, creating excesses that enable lending for profit. The demand for money to participate in economic exchange ensures lending, which inevitably carries fees or interest as lenders seek compensation for risk and time. Financial institutions, built to store and manage money, amplify this by profiting from lending, making no-usury systems impossible. Fractional reserve banking, prevalent in modern economies, expands money supply, concentrating wealth among elites who lend at interest, further entrenching usury. Historical attempts at no-usury, from medieval Europe to modern experiments, reveal hidden obligations, labor, taxes, or social pressures that replicate or exceed the harm of explicit interest, proving the concept's infeasibility. The act of lending itself demands a return, as money's value lies in its circulation for goods and services. Banks, central to storing wealth, cannot operate without profit, whether through interest or fees, as they manage depositors' funds and economic risks. Modern monetary systems, debt-driven and reliant on credit, depend on usury to function, as seen in global economies like the United States, Europe, and China. These systems thrive on fractional reserve mechanisms, where banks create money through lending, ensuring usury's permanence. Historical no-usury claims, often cloaked in ethical or religious rhetoric, collapse under scrutiny, revealing exploitative practices worse than transparent interest. This essay argues that no-usury is impossible due to human nature's hoarding instinct, the economic necessity of lending, and the institutional reliance on interest in fractional reserve systems. For sections explore these conceptual barriers, culminating in a conclusion that only private, trust-based loans approximate no-usury, while systemic attempts are doomed by greed and structural realities. Human nature and the drive to hoard and lend. Human nature's propensity to hoard wealth fundamentally undermines no-usury monetary systems. Individuals accumulate money, whether gold coins in ancient economies, paper currency in colonial times, or digital balances today, to secure resources and status. This hoarding creates surpluses, enabling those with excess to lend to those in need, who require money for economic participation. Lending, however, is not altruistic. Lenders demand compensation for the risk of non-repayment and the opportunity cost of parting with funds. This compensation, whether interest, fees, or alternative obligations, constitutes usury, rendering no-usury systems unattainable. Historically, hoarding and lending persisted across civilizations. In medieval economies, elites stockpiled gold and land, lending to peasants who repaid through labor or produce, creating feudal dependencies akin to debt slavery. In early modern trade networks, merchants amassed wealth and lent at profit, disguised as partnerships to skirt religious bans. Even in experiments designed to curb hoarding, such as Austria's 1932 Wurgel script with demurrage fees, opportunists hoarded goods or influence, subverting the system's intent. Human greed ensures that accumulated wealth is leveraged for gain, as lenders exploit borrowers' need for money to access goods and services. The necessity of money for economic exchange amplifies this dynamic. Without money, individuals cannot purchase essentials or engage in trade, creating constant demand for loans. Those with surplus wealth, whether individuals or institutions, capitalize on this, charging interest or equivalents to ensure returns. This cycle, driven by human opportunism, makes no-usury a fantasy. Even in small communities, where trust-based loans might avoid interest, social pressures or expectations of reciprocity introduce burdens, proving that human nature's self-interest precludes systemic no-usury, as lending always carries a cost. Institutional incentives and the profit motive. Financial institutions, designed to store and manage wealth, render no-usury systems impossible by their profit-driven nature. Banks emerged to safeguard money, whether coin, paper, or digital, allowing individuals to save securely. To operate, banks incur costs: infrastructure, security, and risk management. These costs necessitate revenue, primarily through lending at interest or fees, as deposits alone cannot sustain operations. This structural reality ensures usury's persistence, as banks leverage accumulated wealth to meet economic demand for credit. Historically, institutions have always profited from lending. In ancient economies, temples stored wealth and lent at profit, often disguised as offerings. In medieval systems, moneylenders and early banks used loopholes like penalties to extract returns, despite religious bans. Modern Islamic banks, claiming no usury, rely on profit-sharing models that mimic interest, as seen in their $4 trillion market by 2023. These institutions, whether state-run or private, cannot function without returns, as depositors expect safety and borrowers demand access to funds for economic participation. The formation of lending institutions is inevitable in any monetary system, as wealth concentration creates a lead to institutionalize lending for profit. Even in experimental systems like colonial scrip economies, governments issued loans tied to taxes or goods, imposing burdens akin to usury. The necessity of credit for trade and growth ensures that banks, as custodians of wealth, charge for lending, whether through explicit interest or alternative fees. This institutional profit motive, rooted in human greed and economic necessity, makes no-usury systems infeasible, as banks cannot operate charitably on a systemic scale. Fractional reserve systems and money creation. Fractional reserve banking, a cornerstone of modern monetary systems, entrenches usury by enabling money creation through lending. Banks hold only a fraction of deposits as reserves, lending out multiples of their holdings, which expands the money supply. This process concentrates wealth among financial elites, who lend at interest to profit from the demand for money in economic exchange. The United States, Europe, and China rely on this debt-driven model, where credit fuels growth but binds borrowers to interest payments, making no usury impossible. Historically, fractional reserve principles appeared in early modern Europe, where goldsmiths issued notes beyond their reserves, charging interest. In modern systems, banks create digital money through loans, with global debt reaching $305 trillion by 2023. This system thrives on usury, as banks profit from interest on created money, incentivizing lending over charity. Even historical no-usury attempts, like colonial scrip, relied on repayment in goods or taxes, mimicking usury's effect. The expansion of money supply through lending ensures that those with excess wealth, amplified by fractional reserves, lend at a cost, as economic participation demands credit. Reversing this debt-driven model is infeasible. Businesses and individuals require loans for investment and consumption, and banks, as profit-driven entities, charge interest to cover risks and sustain operations. Alternative systems, like those claiming no usury, introduce obligations, labor, taxes, or social expectations that replicate usury's burden. The systemic reliance on credit creation, rooted in human demand for money and institutional profit motives, ensures that no usury remains a pipe dream, as lending inherently carries a cost. Historical failures and modern monetary realities. Historical claims of no-usury monetary systems consistently fail, revealing exploitative practices that undermine their rhetoric. In medieval Christian economies, bans on interest led to feudal obligations, binding debtors to labor or land, worse than transparent interest due to coercion. Islamic systems, using coins and barter, impose social pressures for gifts, resembling usury. Nazi Germany's regulated 4.5% interest loans masked debt as no usury, relying on plunder. Wergel's demurrage scrip required tax repayment, a hidden burden. These systems, despite anti-usury claims, introduced alternative costs, labor, taxes, or prestige, driven by human greed and economic necessity. Modern monetary systems, built on fractional reserve banking, are inherently debt-driven. The United States Federal Reserve, Europe's ECB, and China's PBOC create money through lending, with interest rates, e.g., 4 to 5% in 2023, sustaining bank profits. Global debt markets, financing everything from infrastructure to consumer spending, rely on usury as borrowers pay for access to money. Reversing this is impossible. Economies collapse without credit, and banks cannot lend without returns. Even alternative systems, like mutual credit, require reciprocal trade, a form of obligation. The act of lending, whether by individuals or institutions, demands compensation due to risk and time, making no usury unattainable. Human nature's hoarding instinct and the need for money in economic exchange ensure usury's permanence. Wealth accumulation creates lenders, and demand for credit creates borrowers, with banks bridging the gap through interest. Historical and modern systems confirm this. No usury claims collapse into exploitative practices as human opportunism and institutional realities demand returns, rendering systemic no usury a delusion. Conclusion: human greed and financial systems ensure lending's cost. The impossibility of no usury monetary systems stems from human nature's greed, the economic necessity of lending, and the structural realities of fractional reserve banking. Individuals hoard money, coin, paper, or digital, creating surpluses that enable lending for profit as economic participation demands access to funds. Lenders, driven by self-interest, impose interest or fees to offset risks, ensuring usury's inevitability. Financial institutions, tasked with storing wealth, amplify this by profiting from lending, as seen in modern debt-driven economies like the United States, Europe, and China, where fractional reserve systems create money through interest-bearing loans. Historical attempts, medieval Christian bans, Islamic finance, Nazi reforms, Wurgel script, failed to eliminate usury, imposing labor, taxes, or social pressures that often surpassed explicit interest and harm due to their opacity and coercion. The act of lending inherently carries a cost, as money's value lies in its use for goods and services. Banks, central to modern economies, cannot operate without returns, making no usury systems infeasible. Fractional reserve banking, by expanding money supply through lending, concentrates wealth and entrenches usury, as global debt markets demonstrate. Reversing this model is impossible. Economies rely on credit for growth, and lenders demand compensation, whether through interest or alternative burdens. Historical no-usury systems, despite ethical rhetoric, collapsed into exploitative practices driven by human opportunism and the need for economic exchange. Only private, trust-based loans among individuals, typically small-scale and short-term, approximate no usury, expecting only principal repayment. Yet, these are fragile, risking relationships, and unscalable for systemic needs. The obvious truth: systemic no usury is unattainable due to human greed and economic realities, exposes the futility of such claims. Modern monetary systems, built on debt and interest, confirm that usury is inseparable from lending, as banks and borrowers navigate a world where money's accumulation and demand ensure its cost. This critical examination affirms that no usury is a myth, doomed by human nature and the inescapable structure of financial systems.